Hi, Matt McAleer. February 19th, just after the close. Underneath a fairly quiet week in the indexes, a lot of action in the old industry names. Industrials, basic materials, strong. Banks, very strong. Energy, oil and gas, leaders this week, off of some of that headache down in Texas going on. We'll see what happens in terms of supply, tight supply, prices ramping in natural gas and oil. Gets us to something we've been talking about for, 5 or 6 months now. And that is trying to barbell your growth and value approach to the markets. It's been 5, 6 years where large cap growth is where you want it to be. Started seeing that relative strength come back in value, small and mid, August, September. Important to recognize that and not get stuck into one approach in the markets. You know, it's very easy and it's enjoyable to research and look at high-tech names, whether it's software as a service, cloud names, fintech names. Let's not forget, we've been through this. There's nothing new in the market. There's new names, there's new companies. Cycles are always omnipresent in the markets. Let's go back to 1998, 1999. What did we see? Jacobs Internet Fund, Seligman Communications and Information Fund, two monsters. First Hand funds. They would roll these managers out every week to talk about their new holdings. What happened when that kindling started to get hot and that money needed to get out the door? That door is only so big. Tripping over themselves getting out. Be careful how you're allocated. If you're over-allocated to sectors that have seen a big move, consider taking some off the table and allocating to some other areas. We've got great breadth, great movement in many sectors and industries. Take advantage of it. Moose will be going over this move in interest rates. 135 on the 10-year. 6 months ago, we were at 70 basis points. I tip my cap to the Moose. Where were we on duration 6 months ago? Tight as a drum at 60 and 70 basis points. Now, as rates have started to move, so can John and his team start moving out on maturities, locking in some of these higher rates. Would love to see some of these muni rates catch an upward swing like we've seen in the Treasury market. Let's see what happens next week. Everyone have a great weekend.
Good afternoon. It's John Musso. I'm the CEO and Director of Fixed Income here at Cumberland Advisors. It is Friday afternoon, February 19th. Bond markets this week, more of the same. We saw the 10-year bond in Treasuries move up from a 121 to a 134. That is a rise of 13 basis points. We saw the 30-year bond go from a 201 to a 214, another rise of 13 basis points. Keep this in perspective, the 2-year bond did nothing. It's been at 11 basis points since the beginning of the year. What does this mean? It means yield curves are becoming steeper. We associate that with an economy that is growing, with a bond market that's expectations that it will continue to grow. What's different this week? What's different this week is that muni yields went up more than treasuries. We have not seen that in a long time. You heard me talk last week how municipal yields were not moving at all. Well, this week they moved up about 18 basis points. Still much lower than treasuries, but certainly when you look at the yield ratios, munis to treasuries, starting to see some give. It's been a long time since we've seen some give. We have a little chart to show you which shows you the yield ratio between a AAA municipal index and the 10-year Treasury index. It got down to as low as almost 50%. And when you look at that, you scratch your head, because for the average tax rate, which is in this country is probably around 25%, but even someone that would be at, say, a 37% tax rate, anything below a 63%, you'd say, I'm better off owning a U.S. Treasury. You almost never say that. And clearly, you would have been better off owning any taxable security than a muni bond at that level. What does that mean for an investor here at Cumberland when we manage portfolios? Certainly we're not selling bonds and realizing capital gains to move out of existing munis, but it means we're very careful about the munis that we are buying, and in some cases maybe buying some taxable munis that make more sense. Some of the signs we saw this week of the economy getting a little stronger: producer price index. Market was expecting 0.2 for the month. It got 1.2. Is that an outlier? Sure, probably, but we're going to watch it. We're going to continue to watch CPI. We're going to watch initial jobless claims. A little disappointing this week, but the market shook it off. They were in the 800 level. They wanted to be in the 700,000 level. Thing is, the market's expecting the economy to do better. We're expecting to see a vaccinated economy rise. And when we look at this, we have to look at it not only with the big picture numbers, but also with some anecdotal looks too. I got an email today. The Knicks and the Rangers in New York are starting to admit fans in March. Doesn't mean much on the face of things, but it's a great corner to turn. And you can find anecdotal evidence of these things in cities across the country. So as we come out of this mess, you know, our signposts are kind of back to where we were probably at the start of last year, which was a 10-year bond in the 190 range. It's got a while to go to get there. We think it gets there as you move up the scale on vaccinations. So we'll look for you next week, and we hope you enjoy the weekend. Thanks a lot.